IFRS feels confusing, right? What if you could understand it easily? Watch the full video and master IFRS.
Hello viewers, welcome to my channel. In today's video, we will be discussing the key IFRS and IAS standards of ACCA financial reporting. So this particular video is mainly designed for the key standards or key IAS standards which you need to know before attempting ACCA financial reporting exam. So we will be discussing all the key IAS and IFRS standards. So here you can see on this particular slide, the first one, IAS 1, that is financial statements, nothing but the IAS 1 which deals with the preparation of financial statements. So normally financial statements generally include the statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in exam and key notes. And always do remember this particular standard mainly focus on going concern, consistency and accrual principles. So in exam you can expect a question on these particular three major principles. So normally if you observe here, financial statements must present this particular standard clearly states that financial statements must present a true and fair view using the consistent policies. So as per IAS 1 presentation of financial statements, all the financial statements which we prepare, that is a statement of financial position and statement of profit or loss or other comprehensive income or statement of changes in equity and notes, all these financial statements need to prepare from true and fair view perspective. And you need to mainly focus into the classification of current as well as non-current. This is a major critical area from the exam perspective. It means you need to know how to classify a current and non-current. It can be an asset or it can be a liability. Now if you see the next standard, that is IAS 2, that is inventory valuation. So in inventory valuation, the major things which you need to know is, the first thing is always we need to value the inventory lower of cost or NRV. NRV is nothing but net realizable value. So the key methods which is focused by this particular accounting standard 2 is first in first out method and weighted average. Now always do remember from ACCA FR exam point of view, always do remember that inventory cannot be overstated, point to be noted, and losses, whatever the inventory losses are there, it need to be recognized immediately. And what is this NRV? Net realizable value is nothing but the selling price minus the cost. And always do remember LIFO generally LIFO is not allowed. IAS 2 mainly focus on either FIFO or weighted average. So LIFO method is not considered. So from exam point of view, you should be very clear that what we need to consider. That is lower of cost or NRV. What is NRV? Net realizable value. How we will get net realizable value? That is selling price minus cost. And if you see the next cash flow, that is IAS 7, which deals with cash flow statement. Now this particular standard mainly focus on the cash is mainly categorized under three heads: cash from operating, cash from investing and cash from financing activities. And always do remember the main objective of the cash flow statement is to project the liquidity, not the profitability. And if any non-cash cash items, it means in order to get the cash from operating activities, always do remember we do nothing but in order to prepare a cash flow statement, we do take the reference of income statement and the balance sheet, nothing but statement of profit or loss and statement of financial position. So here from statement of financial position, we try to take the working capital changes because we need the changes in the working capital, and we also need some non-cash expenses which we get it from statement of profit or loss as well as statement from financial position. So whenever you are doing this, the first important point which you need to remember when you are preparing a cash flow statement as per IAS 7, if any non-cash expenses are there, we need to add it back. So like depreciation, we need to add back. And the next standard is IAS 8. Normally IAS 8 mainly focus on changes in the accounting policies. It's mainly focused on the changes in the accounting policies. And always do remember, whenever there is a change in an accounting policy, that change need to be applied retrospectively. and if any errors are there, we need to restate the errors. And main purpose of this particular IASI, changes in accounting policies and accounting estimates and errors, here its main focus on the it means it ensures the comparability across the periods, and if any prior period errors are there, it must be corrected. So this is the main purpose of this particular accounting standard 8. And if you see the next standard, that is IAS 10. So IAS 10 mainly focus on events after the reporting date. If any events occur after the reporting date, then how we need to deal with those events. So there are main elements which we need to understand here, like if what kind of events is, whether these events are adjusting events or non-adjusting events. Now this standard says that we need to adjust these events if it nothing but adjust if it provides the evidence of conditions at the reporting date. It means we need to adjust in the current financial statement if it provides the evidence of conditions at the reporting date. If there is no evidence, then you need to just disclose it. So we need to adjust the transaction only when if there is any evidence of that particular condition on the reporting date. So here an exam tip, if you see the dividends after the year end, so always you need to, if any dividend is declared by the company after the year end or after the reporting date, we cannot consider it as a liability. Then the next standard IAS 16, which deals with property, plant and equipment. So the major thing which we need to focus in IAS 16 is the different how we need to measure it. We measure it by using either cost model or the revaluation model, and you should also know how we need to depreciate this property, plant and equipment. And there are certain components like OCI, when there is any derecognition of PPE, how we need to treat it. So from the exam point of view, always do remember IAS 16 allows to measure a property, plant and equipment either by using cost model or revaluation model, and it is compulsory to charge depreciation if the asset is generating any, if the asset is having the capacity to generate any probable economic benefit. So always do remember, assets are capitalized and depreciated over the useful life of an asset. Normally depreciation is computed on the basis of useful life of an assets, and whenever there is a reflation, nothing but revaluation, so this particular revaluation need to reflect the fair value changes. And most important thing which you need to remember, when there is a derecognition or when there is a disposition of an asset, if there is any gain, then we need to account it in other comprehensive income, and if it is any loss, we need to account it in statement of profit or loss. Then if you see the next standard, that is IAS 36, which deals with the impairment of asset. So the key components which you need to know in the impairment of assets is the asset is impaired. It means what exactly the impairment means. So the impairment means if the carrying value of the asset is more than the recoverable value of an asset. In simple terms, if the carrying value of an asset exceeds the recoverable amount, then we do consider that asset as an impaired assets. Because the main objective of this particular IAS 36 is it will stop the company to overstate the assets. And do remember, generally the goodwill impairment cannot be reversed. Always do remember, because in case of impairment, if in any future date, if the recoverable value is more than the carrying value, then there is a possibility of reversal of impairment. But this reversal of impairment is not applicable for the goodwill. That you need to mainly remember from ACCA FR exam point of view. Then if you see the IAS 37, which deals with the provisions and contingent liabilities. So always do remember, in this particular standard, you need to clearly know what need to be recognized as provision and what need to be recognized as a contingent liability. So generally, if the obligation for cash outflow is probable, then we do recognize it as a provision. It means that if any if any event obliges a company for a cash outflow in future, definitely if a company is expecting any loss and if the loss results in cash outflow, definitely IAS 37 makes it mandatory to recognize it as a provision. So recognize only if the obligation is probable and measurable. If the obligation is not properly measurable, then you cannot recognize it as a provision. So we need to recognize this future obligation of cash outflow only when it is probable and measurable. And if there is any contingent liability is not part of the balance sheet, then you need to show it as a it means contingent liabilities are need to be disclosed, but it is not part of the balance sheet. So you need to know the difference also, what is provision and what is contingent liability. In the next standard, if you see IAS 38, which deals with intangible assets like patents, brands, copyrights. Now when it comes to the intangible assets, you need to know when we need to capitalize the expenses like development expenditure, because all research expenses we generally show it as an expense. But when it comes to the development expenses, so if certain conditions are fulfilled, then we need to capitalize that particular development expenditure as an intangible asset. So only identifiable and controllable assets are recognized. So it means entity need to have a control on that particular asset, and these assets need to be identified. Then only we need to show it as an intangible asset. And this asset need to have the capacity to generate economic benefit, nothing but probable economic benefit in future to the entity. Then if you see the next standard, that is IAS 40, which deals with investment property. So the main purpose of this investment property is generally it generates secondary income to the entity. So always as per the standard, we can either use the fair value or the cost model to measure this particular investment property. But the major thing which you need to know is the investment property is nothing but the property which is held by the company to generate the secondary income. It means a company expects both revenue return as well as the capital return from this particular investment property. So if there is any change in the fair value, then we need to account this particular change through statement of profit or loss account. So the fair value changes, we account it through statement of profit or loss account. Then the next standard, IFRS 15, which deals with revenue recognition. So always do remember IFRS 15 mainly focus on 5 steps model. So 5 steps model generally deals with, first we need to identify the contract. Then we need to see how many performance obligations are there in that particular contract. Then we need to identify the transaction price. Then we need to allocate the transaction price among the performance obligation. And the last point, which is very important, we need to recognize the revenue only when the performance obligation is fulfilled. This is very important, which you need to focus. So revenue is recognized when the control transfers, and always, as I mentioned, you need to focus on the performance obligation. The next one is IFRS 9, which deals with financial instruments. So there are certain key terms as per IFRS 9 that recognizing a financial instrument either by using amortized cost method or fair value through other comprehensive income or fair value through profit or loss, and the ECL, nothing but expected credit loss. So what the standard mainly focus? So assets classified based on business model and the cash flows. Generally financial instruments mainly focus that assets are classified, financial assets are classified on the basis of business model and cash flows. And always you need to know how to compute the expected credit loss. So the main purpose of expected credit loss, that it ensures the company to recognize the loss. Then IFRS 16 deals with the leases. That there are two important terms in this particular as per the standard, that is right to use of asset. You need to know how to recognize, how to compute the right to use of asset as well as the present value of the lease liability. So in this case, we need to recognize, the lessee recognizes the assets and liability in his respective books, and always do remember it, we need to eliminate the off balance sheet financing. So if a company, if a lessee took an asset on lease basis, the first step is there should be a computation of present value of the lease liability, then right to use of asset. Then accordingly we need to compute the depreciation on the leased asset, which we need to account it in statement of profit or loss. Then accordingly you need to compute the finance cost, which we need to show it in the statement of profit or loss account. And again the lease liability need to be categorized into non-current lease liability and current lease liability, and it need to be reflected in the statement of financial position. Then IFRS 10 deals with consolidation, nothing but the consolidation principles, which mainly focus on the group financial statements and the control thing. So always do remember, a company which is having a controlling right on the other company, then that company is considered as a parent company and the other company is considered as a subsidiary company. So it means an investor who is having a controlling right is considered as a parent company and the investee company is considered as a subsidiary company. So the main thing is control. Now control is nothing but power plus reduce. And always parent company is having the responsibility to prepare the consolidated financial statements. So the purpose of this consolidated statements means it reflects the economic reality of the group. Now the next one, IFRS 3, which deals with the business combinations. So in this particular business combinations, the main thing is identify the assets and liabilities at fair value, and goodwill arises from excess consideration. Nothing but if the purchase consideration is more than the net assets of the company, net assets of the subsidiary company, then there is a possibility of arising the goodwill, and accordingly we will be recording it in the consolidated statements. But always do remember, at the time of this acquisition, the assets and liabilities need to be valued at the fair value. Then IAS 28, which deals with associates. Normally in case of consolidation, we mainly focus on the control of power, but when it comes to the associate, generally in case of associate, you need to have the right of significant influence. If a company is having a significant influence on another company, then that can be considered as an associate company. Suppose if X company have a significant influence on Y company, so then Y can be considered as an associate of X. So what IAS 28 speaks about associates, always we need to follow the equity method of accounting in order to record these associate transactions in the book, and parallelly there is a share of profit also. So always do remember, investor recognizes the share of profit, and the whatever the dividends are there, the dividends will generally reduce the carrying amount as per this equity method. Then IAS 21, foreign exchange transactions, nothing but currency, foreign currency, how to deal with the foreign currency or exchange differences in the foreign currency. Always do remember, IAS 21 clearly says that we need to record at the closing rate or nothing but closing exchange rate at the end of the reporting date. And if there is any exchange difference, it need to be routed through profit or loss account. So exchange difference goes to the profit or loss account, and it generally ensures the current valuation in the reporting currency. Always do remember, all monetary items we generally present in the financial statements at the closing rate. Then IAS 19, which deals with the employee benefits. There are two: defined benefits and defined benefit plan and defined contribution plan. So the main thing which you need to know about this is, generally defined benefit involves the actual valuation, and whatever the gain and losses are there, it need to be routed through other comprehensive income. So you need to know the clear difference, what comes under defined benefit plan and what comes under defined contribution plan. Now generally nowadays most of the employees prefer the defined contribution plan, because defined contribution will not create any obligation to the employer, but if it is a defined benefit plan, definitely an obligation is created. Then IFRS 5, which deals with assets held for sale. So normally if the company planning to dispose an asset, then IFRS 5 clearly states that first you need to recognize it as assets held for sale. So on what basis we recognize? We generally recognize lower of the carrying value and the fair value. So the moment when the asset is recognized as asset held for sale, then we need to stop depreciating that. So from the exam point of view, do remember, assets which are expected to be disposed soon or maybe in the next 12 months, then these assets need to be recognized as assets held for sale. The moment when an asset is recognized as assets held for sale, the depreciation need to be stopped. And at what value we need to show it in the books? The lower of carrying value and the fair value. Whichever is lower, that we'll consider as the value of the asset 20%. Then IAS 23, which deals with the borrowing cost, which mainly focus on capitalizing the borrowing. Nothing but borrowing cost is nothing but the interest. Suppose if the company borrowed any loan for constructing an office building, so before completion of that particular construction, whatever interest expenses the company incurred, IAS 23 allow the company to capitalize that particular interest expenses. But this is applicable only when the asset comes under the category of qualifying asset. Now here you need to clearly see the cost directly related to the construction or capitalized, and if it is not related to the construction, then the other we will be showing it as a expense in the financial statements. But this is applicable only when the asset is categorized as a qualifying asset. Here IAS 12, which deals with income taxes, where you need to know what is current tax, what is deferred tax. And now normally if you see, you can observe in this particular slide also, normally the deferred tax is something which is levied when there is a temporary difference between the accounting profit and taxable profit. So whatever temporary difference arised between this accounting profit and taxable profit, that is generally termed as a deferred tax. So this ensures the tax expense reflects the true financial performance. So this particular deferred tax is very important for your ACCA exam. So the major thing which you need to understand, the deferred tax concept. What is this temporary difference? This is the major elements, and so as I mentioned, temporary difference creates the deferred tax. Then the IFRS 8, which mainly focus on segment reporting. So generally this particular standard says if the company is having multiple segments, it is always required to project the performance of these multiple segments. Nothing but here you can see it is mandatory as per IFRS 8 for an entity if the entity is having multiple segments, nothing but multiple verticals, or what is this, multiple business units. So disclose the performance of different business units as per this is compulsory as per IFRS 8, and this is generally based on your internal reporting. Then IAS 24, which mainly focus on the related party. The main objective of this particular standard is to project the transparency and to eliminate the conflict of interest. So the transactions with the related parties must be transparent. Suppose example, if a company is paying let us assume that the company is paying an honorarium to the spouse of the director, then it comes under the related party transactions. So always do remember IAS 24 makes mandatory that if any related party transactions are there, it need to be disclosed separately. Suppose if whatever the commission payable to the key personnel of the company, salary payable to the key personnel of the company, nothing but the salary payable to the CEO, salary payable to the managing director, it need to be disclosed separately as related party transactions. The main purpose of this particular accounting standard is to enhance the transparency of the financial statements. So here these are the key standards which an ACCA student need to know before appearing the financial reporting paper. So for your final revision summary, you can see in this particular slide also revenue IFRS 15, and when it comes to assets is IAS 38 and IAS 16, and liabilities IAS 37. Even IAS 40 also comes under assets. And when it comes to the group financial statements, IFRS 10 consolidation principles, IFRS 3 business combinations. When it comes to finance, IFRS 9. Always do remember all these particular standards, whatever accounting standards which we discussed from the last 15 minutes or 20 minutes. Always do remember you need to mainly know how we need to recognize, how we should measure, how we should disclose. These are the major three components which every ACCA student need to know: how to recognize, how to measure, how to disclose. And do remember, this is the major exam focus area. So from the exam point of view, if you want to score maximum marks related to all these standards, you are expected to know how to recognize, how to measure, and how to disclose. So all the best for your exams.
Subscribe to Account Finance with Ravi for finance and accounting insights.